The CME just raised margin requirements again, not Friday, Saturday. They published the notice over the weekend when nobody was watching. Gold margins going from 6% to 8%. Silver margins jumping from 11% to 15%. And these changes take effect after Monday's close, which means anyone still holding leveraged positions in precious metals has exactly one trading session to either deposit additional capital or liquidate. And I want you to think carefully about what that means given what just happened over the past 72 hours. I spent the weekend going through every filing, every margin notice, every sequence of trades from Thursday through Monday morning, and what I found is not a continuation of Friday's story, it is an escalation. The mechanism that triggered the largest single-day gold crash since 1983 and the worst silver collapse since 1980 is not only still in motion, it just got more aggressive. And not a single mainstream outlet is connecting these pieces together, not one. They are giving you Kevin Wersch. They are giving you Fed policy. They are giving you hawkish versus dovish narratives, and none of that is wrong. But it is incomplete in a way that will cost you money if you do not understand the full picture. Because wars was the catalyst. The margin hikes are the mechanism. And the mechanism is what actually moves prices in markets like this. So here is what we are going to cover today. First, I am going to walk you through what actually happened between Friday and Monday, the full sequence, not the headline version. Then I am going to show you the specific margin data that the CME published over the weekend and explain why the timing of that announcement matters enormously. Then I am going to connect this to the historical pattern we have seen before, because this is not new. This playbook has been run multiple times and it produces remarkably consistent outcomes. And finally, I am going to give you a framework for thinking about what comes next. Not a prediction, not a trade recommendation, but a way of understanding the structure so you can make your own informed decisions. This channel exists for people who want to understand the system before they react to it. That is what Financial Crux is built around. Macro risk, market structure, precious metals, capital preservation, no hype, no predictions, just a clear-eyed look at how these markets actually function. If that is valuable to you, subscribe. And if you want real-time updates when events like this unfold, join our WhatsApp community. The link is in the description. We also post daily analysis on X, formerly Twitter. Follow us there because what we are covering today is exactly the kind of analysis that moves faster than YouTube uploads, and you want to see it when it happens, not 3 days later. All right, let us get into it. Let me set the scene so you understand the context of what just happened. Thursday of last week, gold is trading above $5,500 an ounce. Silver has just touched $121. These are all-time highs, not inflation-adjusted highs, not nominal highs relative to some baseline. The highest prices these metals have ever traded at in recorded history. Gold is up roughly 70% over the past 12 months. Silver is up over 135%. Every category of investor, retail traders, hedge funds, pension allocators, sovereign wealth funds, central banks has exposure to precious metals at that moment. The trade is crowded, leverage is elevated, and the futures market is stretched to a degree that makes it structurally vulnerable to exactly the kind of event we are about to see. Then Friday happens. The news drops that Donald Trump has nominated Kevin Wersch as the next chair of the Federal Reserve. Wersch is a former Fed governor. He is viewed as more hawkish than other candidates. He has publicly supported shrinking the Fed's balance sheet. He has been generally supportive of a strong dollar, and markets interpret this nomination as a signal that the era of aggressive monetary easing may be coming to a pause. Now, this is important context because the precious metals rally of the past year has been built substantially on what analysts call the debasement trade. The thesis is straightforward. Central banks have printed unprecedented amounts of money since 2008. Government debt levels globally are at historic highs. At some point, the real value of fiat currencies will erode, and hard assets with fixed supply, gold, silver, will appreciate relative to those currencies. That thesis has been the engine behind the rally, and a hawkish Fed chair is perceived as negative for that thesis because tighter monetary policy strengthens the dollar and reduces the urgency of the inflation hedge. So the narrative on Friday was simple. Wersch spooked the market. The debasement trade unwound. Gold and silver sold off. End of story. Except that explanation does not account for the magnitude of what happened. Gold fell over 9% on Friday. That is the largest single-day decline since 1983. Think about that. In over 40 years of trading, through every crisis, every war, every recession, gold has not fallen this much in a single session. Silver dropped 27% on Friday and continued falling into Monday, touching $79 at its low. The silver move is the largest since 1980, since the Hunt brothers collapse. And I want you to ask yourself a question. Does a Fed chair nomination, even a hawkish one, justify the largest precious metals crash in 4 decades? Does a shift in policy expectations, not actual policy, just expectations, explain a $42 drop in silver in a single session? It does not, and the data shows exactly why. What mainstream media did not report or reported only in passing without connecting the implications is that the CME Group raised margin requirements on precious metals futures at the same time the worst news was hitting, and then on Saturday, they raised them again. Let me walk you through the specific numbers because they matter. Prior to Friday, the margin requirement for gold futures was approximately 6%. That means if you wanted $100,000 of gold exposure, you needed to post $6,000 in margin. After the weekend announcement, that requirement goes to 8%. That is a 33% increase in the capital required to hold the same position. For silver, the numbers are even more dramatic. Silver margins were at 11%, they are now going to 15%. That is a 36% increase. Now let me explain what happens mechanically when margin requirements rise this sharply. If you are a trader holding a leveraged position and the margin requirement increases, you have two options. Option 1, deposit additional funds immediately to meet the new requirement. Option 2, close your position, sell right now. And here's the critical detail. Most traders who are fully leveraged, who have maximized their exposure because the market has been running for months and the incentive to capture gains has been overwhelming, do not have additional capital sitting on the sidelines ready to deploy. They are fully invested, which means when margin requirements spike, they have no choice. They must sell. And the CME has complete visibility into the leverage data across their entire platform. They know exactly how many positions are at maximum leverage. They know precisely how many forced liquidations a given margin increase will trigger. This is not speculation. This is how the system works. The exchange can see the positioning in real time. When they raise margins, they know the mathematical outcome before it happens. What Friday looked like from a market structure perspective was not a news-driven sell-off. It was a forced liquidation cascade. Traders who could not meet margin calls were forced to sell. Their selling pushed prices lower. Lower prices triggered more margin calls. More margin calls triggered more selling. The cascade feeds on itself until the leverage is flushed from the system. And at the exact moment that liquidation cascade was running, liquidity in the market was compromised. Asian markets were closed or closing for the weekend. The London Metal Exchange experienced system issues. HSBC, one of the largest players on the LME, had trading systems go offline. Whether these were coincidental technical failures or something else, I cannot say definitively. What I can say is that the timing removed liquidity support precisely when the selling was most intense. Then over the weekend, with the market closed and traders unable to adjust positions, the CME published the notice that margins were going up again. Gold from 6 to 8%, silver from 11 to 15% effective after Monday close. So anyone who survived Friday's liquidation event and is still holding a leveraged position now has exactly 1 day to either find additional capital or sell, and Monday's price action reflected that reality. Gold fell another 3.6%. Silver dropped another 6.7%. The cascade continued, and I want to be clear about something. The Wirsh nomination is real. The hawkish policy shift is real. Those factors are genuinely relevant to the medium-term outlook for precious metals. But they do not explain the magnitude or the mechanics of what happened over these 72 hours. The margin hikes do. And the sequence of those hikes, Friday-Saturday announcement, Monday implementation, created the maximum possible forced selling pressure on the market. This is not the first time this playbook has been used, and once you see the pattern, you will recognize it every time it occurs. 1980, the Hunt brothers, two Texas oil heirs, attempted to corner the silver market. They accumulated massive positions in both physical silver and futures contracts. Silver ran from $5 to $50 in a matter of months. Then the exchange changed the rules overnight. A new regulation stated that traders could only sell. No new buying was permitted. Margin requirements were raised repeatedly. The Hunts could not meet their margin calls. Silver crashed 80%. The Hunt brothers, who had been worth billions, were financially destroyed. Now that was a speculative bubble driven by two individuals trying to manipulate the market. When the speculative layer was removed, there was nothing underneath, but the mechanism that removed that layer was margin manipulation. The exchange changed the rules to produce a specific outcome. 2011, 3 years after the global financial crisis. Faith in the banking system was at a historic low. Investors piled into gold and silver as a hedge against currency debasement. Silver ran from $18 to $49. And then the CME raised margin requirements 5 times in 2 weeks. 5 times. Leveraged traders were systematically flushed out. Silver crashed 48%. The fear trade unwound. December 2025, just last month, silver hit $84, an all-time high at that point. The CME raised margin requirements twice during the holiday trading window. This is the thinnest liquidity period of the year. Almost no traders are actively monitoring positions. Silver crashed 13% overnight and now January 2026. Silver at 121, gold at 5,500. Margin requirements raised Friday, raised again Saturday. Largest single-day crashes in over 4 decades. Same mechanism, same outcome. 4 times in 44 years, same playbook. The only variable that changes is the narrative used to explain it afterward. In 1980, it was the Hunt brothers. In 2011, it was post-crisis volatility normalizing. In December, it was thin holiday trading. This week, it is Kevin Wersch. The narrative shifts. The mechanism is identical. And here is the observation that I want you to sit with. In every single one of these events, without exception, the entities holding short positions in precious metals benefited. When prices crash, short positions profit. The institutions that were short gold and silver on Friday realized significant gains. The institutions that held short positions through the weekend, knowing that additional margin hikes were coming, knew the direction prices would move on Monday. I am not in a position to prove coordinated intent. What I can do is point to the pattern, the mechanism, the sequence, the beneficiaries, and the historical consistency. You can draw your own conclusions. Now, here is where the situation becomes genuinely interesting. And this is the part that most people, including most financial commentators, fundamentally misunderstand about precious metals markets. Gold and silver do not trade in one market. They trade in 2. And over the past 72 hours, those 2 markets have been telling completely different stories. The first is the paper market. That is comics. That is futures contracts and leverage positions. That is where the crash happened. When you look at your phone and see gold at 4,700 or silver at 79, you are looking at the paper market price. The second is the physical market. That is actual metal, bars, coins, refined bullion, metal that exists in the real world that can be held, stored, and transported. Here is what no mainstream outlet reported over the weekend. While the paper market was crashing, physical premiums in Shanghai were spiking. The amount buyers were willing to pay above the paper price to acquire actual physical metal reached elevated levels precisely as the futures price collapsed. 2 markets, same underlying commodity, divergent signals. The paper market was saying, "Get out, this is worthless." The physical market was saying, "I will pay above spot to own real metal right now." And the reason for that divergence is structural. You can manipulate the paper market. Margin hikes, algorithmic triggers, forced liquidations, all of those tools operate within the future system. The exchange controls the rules within that system. The exchange has enormous power to move prices. But you cannot manufacture physical metal. No margin requirement can create additional supply. No algorithmic sell order can reduce industrial demand. The physical market is governed by fundamentals. How much metal exists and how much the world needs. And those fundamentals did not change on Friday. They did not change on Saturday. They did not change on Monday. The supply deficit in silver is now in its 5th consecutive year. The world consumes more silver than it produces. The cumulative shortfall over 5 years is approaching 1 billion ounces. Solar panel manufacturing requires silver. Electric vehicle production requires silver. AI data centers require silver for thermal management and electrical conductivity. These are structural demand drivers built into the core of the global economy. They do not disappear because a futures contract gets liquidated. So what the crash actually accomplished from a structural perspective was this. It flushed leveraged speculators from the paper market, it reset conch's positioning, it allowed institutions holding short positions to cover at the bottom, and it left the physical supply-demand story completely unchanged. Peter Grant, vice president at Zier Metals, told Reuters that the rally in precious metals had taken on a life of its own. What he was describing was speculative excess in the paper market. That excess has now been removed. The futures market has been reset, but the underlying drivers, central bank buying, geopolitical uncertainty, structural supply deficits, those remain exactly where they were before Friday. And here is what the historical pattern shows about what happens next. When margin-driven liquidations occur against a backdrop of weak fundamentals, the asset struggles to recover. 1980 is the example. The Hunt brothers were speculating. There was no structural demand underneath. When the speculative layer was removed, silver took years to rebuild. But when margin-driven liquidations occur against a backdrop of strong fundamentals, the recovery can be remarkably swift. December 2025 is the most recent example. Silver crashed 13% on the margin hikes. Within 2 weeks, it had recovered the entire loss and gone on to make a new all-time high at $121. Why? Because the selling was technical, not fundamental. The leveraged positions were flushed. The fundamental demand remained. And once the forced selling exhausted itself, the underlying bid reasserted. Now I want to be precise here. This is not a statement that gold and silver will recover immediately. They might. The December precedent supports that possibility, but they also might not. The macro backdrop has shifted with the Wirsh nomination. The second margin hike introduces additional forced selling pressure Monday and into the week, and the hawkish Fed narrative introduces genuine uncertainty about the pace of any recovery. What the data supports with reasonable confidence is this. The narrative that this represents a fundamental breakdown in the precious metals thesis is not consistent with the supply-demand reality. This was a paper market event. The physical fundamentals are intact, and historically when those fundamentals are intact, liquidation events like this have been temporary. Daniel Hines, senior commodities analyst at ANZ, told Bloomberg that the fundamentals remain pretty well in place despite the risks around Fed policy. He said the general unbending of the world order and geopolitical tensions continue to support the gold market. Mark Matthews at Julius Baer told Reuters that one of the likely explanations for the sharp falls is that prices collapsed simply because they had already gone parabolic. Once profit-taking started, it just snowballed. These are mainstream analysts acknowledging that the sell-off was technical in nature, driven by positioning and momentum, not by a fundamental shift in the case for precious metals. Now, there is a genuine headwind that the mainstream sources are identifying, and I want to address it directly because intellectual honesty requires acknowledging bearish data as well as bullish. Hansen at Saxo Bank wrote that silver may struggle to keep pace with gold in the coming months. His reasoning is that silver's heavy reliance on industrial demand could become a drag if end users, particularly in the solar sector, seek alternative materials to protect margins. He also noted that a rise in scrap supply is expected as owners cash in long-held bars and jewelry following the massive price increase of the past year. This is a legitimate concern if industrial demand softens because silver prices have risen to levels that squeeze manufacturer margins that represents a potential headwind for physical demand. And if holders of physical silver accumulated over years at much lower prices begin selling to realize gains that represents additional supply hitting the market. These are not reasons to dismiss the silver thesis. They are reasons to watch specific data points going forward. Industrial demand trends, scrap supply levels, substitution activity, and solar manufacturing. If these data points deteriorate materially, the fundamental case weakens. If they remain stable, the case remains intact, and the current crash becomes a technical reset within an ongoing structural bull market. Let me step back and address the macro picture because it matters for understanding the duration of whatever comes next. Central banks have been net buyers of gold for over a decade. They are accumulating the asset they issue their own currency against. That behavior is itself a signal worth paying attention to, and that buying has not stopped because of the Wirsh nomination. Central bank demand is measured in years, not days. The reserve accumulation trend in China, Russia, India, and other nations is a structural shift away from dollar-denominated reserves and toward hard assets. That shift predates Trump. It will outlast Trump, and it provides a floor of demand that did not exist in previous precious metal cycles. Global sovereign debt is at levels not seen since the Second World War. U.S. national debt exceeds $36 trillion. At current interest rates, the cost of servicing that debt consumes an enormous and growing share of federal revenue. And this dynamic exists across most developed economies. At some point, governments will face a choice. They can default on sovereign obligations, or they can inflate their way out, gradually eroding the real value of what is owed. Historically, every time this choice has been presented, governments have chosen inflation. It is politically less visible. It distributes the pain across the entire population rather than concentrating it in a single event. If that pattern holds, and the structural incentives strongly suggest it will, then the long-term trajectory for assets denominated in fiat currencies is continued erosion, and the assets that benefit from that trajectory, scarce commodities, monetary metals, remain well-positioned regardless of who chairs the Federal Reserve. This is not a fringe analysis. This is the thesis held by significant institutional investors, respected economists, and notably, the central banks themselves, through their buying behavior. So where does this leave us? Gold just experienced its worst single-day decline in over 40 years. Silver just experienced its worst single-day decline since 1980. Margin requirements have been raised twice in 72 hours. Additional forced selling is likely Monday and potentially into the week as traders who survived Friday fail to meet the new margin calls. The paper market has been reset. Leveraged positions have been flushed. Short positions have covered. The physical supply-demand picture is unchanged. The structural drivers of demand, industrial applications, central bank buying, currency debasement hedging remain in place, And the macro backdrop, while shifted by the worst nomination toward a potentially tighter policy stance, has not fundamentally altered the long-term case for hard assets in a world of record sovereign debt. If you hold physical precious metals, metal you own outright without leverage, and your time horizon is measured in months or years rather than days, then based on the historical pattern and the fundamental picture, this is not a moment that warrants panic. It is a moment that warrants clear thinking. If you hold leverage positions, your immediate priority is survival. Assess whether you can meet the new margin requirements without being forced to sell at the worst possible moment. If you cannot consider whether reducing position size now on your terms is preferable to being liquidated at prices you do not choose, and if you are watching from the sidelines, understand what has just occurred. The paper market has been flushed. Prices are 35% below where they were last week. The fundamental thesis has not changed. Historically, this combination has preceded significant rallies. Whether that pattern repeats this time is unknowable, but the setup is worth understanding. The most valuable thing I can give you is not a prediction. It is a framework, and the framework is this. Watch the mechanism, not the narrative. When mainstream media gives you a story, wash crash the market. Ask whether that story explains the magnitude and the mechanics of what happened. Look for the margin data. Look for the timing. Look for who benefits. Because in financial markets, the headline is almost never the whole story. The story is written to explain the outcome. The mechanism is what produces it. And if you understand the mechanism, you stop being surprised by these events. You stop panic selling at the exact moment the system is designed to produce panic selling, and you start making decisions based on structure and fundamentals rather than headlines and fear. That shift from reacting to understanding is the most valuable change you can make as an investor. It does not require predicting the future. It requires recognizing patterns when they repeat and responding accordingly. This is exactly the kind of analysis Financial Crux is built around. The mainstream narrative this weekend was war crashed metals. That was the entire story for most outlets. Nobody connected the margin data to the timing, to the historical pattern, to the physical market divergence. We do. If this video was useful, if it changed the way you understand what happened this weekend or how precious metals markets actually function, share it. Anyone holding savings in cash, bonds, retirement accounts, anything affected by monetary policy deserves to understand what we covered today. Subscribe if you have not already. No hype, no predictions, just a clear-eyed look at how the system actually works. And the next time they raise margins, you will know exactly what to look for. Take care.